Elon Musk may be preparing to split apart his largest international asset to clear the path for an entirely new corporate structure. Reports indicate he is exploring a total sell-off of Tesla's massive Chinese operation to facilitate a merger with SpaceX. The Wall Street Journal first detailed this move, with Reuters providing corroboration on July 31, 2026, suggesting that Tesla is actively weighing the divestment. At the center of this proposed consolidation, of course, is Musk himself. Under normal circumstances, a global manufacturer does not willingly abandon its second-largest market. There is no standard business logic for building a world-class supply chain in a major economy only to pack up and leave. Severing ties with an asset this large points to an immense geopolitical pressure forcing Musk's hand, reaching far beyond the typical scope of corporate restructuring. To understand the weight of this decision, we have to look at Tesla's physical footprint in China, anchored by the Shanghai Gigafactory. This chart compares Shanghai's output against the rest of Tesla's global manufacturing. It produces nearly half of all vehicles worldwide. Beyond manufacturing, this revenue breakdown shows local production guarantees direct access to Chinese buyers, the largest electric vehicle consumer base on Earth. The core consumer product driving those numbers relies almost entirely on that local network of parts, labor, and infrastructure. If this highly profitable factory is on the chopping block, its massive financial value has been overtaken by its status as a corporate liability. That liability stems directly from international relations. Tesla's Chinese operations are currently caught in the crossfire of a growing superpower rivalry. From the American side, companies face intense headwinds. The U.S. government is tightening tech export rules and maintaining strict tariffs on foreign manufacturing. Simultaneously, the Chinese government is applying its own pressure, utilizing aggressive state subsidies to elevate homegrown automotive champions. Rivals like BYD have used these state policies to rapidly erode Tesla's market share from within the country. Operating an American tech giant inside China has evolved from a lucrative business opportunity into an unsustainable diplomatic tightrope. SpaceX functions as a heavily classified U.S. defense and aerospace contractor, which introduces a complex layer of federal oversight into any potential merger. A rigid corporate firewall blocks any merger between a China-exposed automotive business and a private aerospace entity guarding U.S. national security secrets. Selling the China unit removes the China-exposed module, allowing the companies to connect on a clean balance sheet. This kind of severe restructuring is likely the only way to satisfy federal regulators and bypass strict foreign ownership laws. Discarding the China business is a strategic amputation, a calculated move to clear the path for a new American mega-conglomerate. The intended end state is staggering, a vertically integrated monolith valued at over $500 billion, spanning terrestrial transportation, energy, and orbital space infrastructure under a single corporate umbrella. Creating that monolith comes with heavy financial hurdles. The markets must determine how to value a profitable private space contractor against a publicly traded automaker currently facing demand issues. Current retail Tesla shareholders face immediate risks, as their automotive investments would suddenly be tied to the extreme capital requirements of private space exploration. Zooming out, this merger sends a clear macroeconomic signal. It represents a pivot away from globalized tech, retreating into a heavily fortified, America-centric corporate empire. To track the progress of this report, monitor official SEC filings, retaliatory signals from Chinese regulators regarding the Shanghai plant, and volatility in Tesla's stock price. While this remains an unconfirmed report, the mechanics of the deal expose deep geopolitical fractures in modern business. It leaves the industry wondering if global regulators will ever allow this level of consolidated power to exist.